use this one. Thank you so much. Thank you, the organizers, for the invitation. It's a pleasure to be here to present a joint work with Alex Edmans, LBS, and Schneemeier from Indiana University. Okay, so this paper is about responsible investment, which is, broadly speaking, is the practice of incorporating some environmental and social factor into investment decisions, and recently it has become very common. And what is the goal behind responsible investment? Well, largely to bring a change in companies in which those investors invest. And how would you do that? Broadly, two channels. One is engagement, another one is divestment. So what is engagement? Engagement is mostly using your voting power or engaging in some discussions with managers, trying to convince them to change firm policy. And that can be effective to a certain extent, although it's very costly. And for many investors, they don't have the skill set needed in order to successfully engage. So the alternative to that is divestment, which simply put is selling companies that exert negative externalities. And there are two main strategies, which I'm going to label as exclusion and tilting. And that's going to be the focus of this paper. So let me talk about each of those strategies separately. So what is exclusion? Exclusion, broadly defined, is a blanket divestment of sectors or companies that investors deem to be irresponsible. And what you can see from this specific ETF example is that they're excluding gambling, alcohol, fossil fuel, controversial weapons, etc. Okay, very simple. And what is the idea? The idea is that we're going to starve those sectors from capital. We're going to let them die slowly. Okay, that's the concept. Now, exclusion is super popular. Okay, like more than 1,500 institutional investors collectively managing more than $40 trillion have committed to exclude fossil fuel companies from their portfolios. Okay, so it's everywhere. And why are they doing that? Why so many asset managers decided to exclude? Well, they're pressured to maximize the ESG ratings or the E&S ratings of their portfolio. They are pressured by asset owners and investors who want like net zero portfolios. There are rating providers. There are academics who study greenwashing by looking at the ESG ratings of those investor portfolio. There is some evidence suggesting that fund flows are affected by changes to ESG ratings of portfolio companies. Okay, so there are seemingly some incentives to maximize your ESG rating. But is it effective? Okay, maybe not, because exclusion really doesn't deprive the company's capital, because if you're going to sell, someone else has to buy. Moreover, many of those industries and sectors are kind of perhaps yesterday's industries in the sense they don't have a lot of growth opportunities that requires infusion of a lot of capital. So the primary market channel might not be as important. And empirically, I know many people are working on those topics nowadays. The evidence is still mixed. It's still, I think, inconclusive to what extent this strategy is really effective. Okay, so what else do we have? We have what we call tilting, which is essentially leaning away from a brown sector and instead only owning or holding the best in class or the ESG leader within that sector. And what is the rationale behind that? The rationale is, well, companies, even brown companies, even, for example, fossil fuel companies, can take some corrective action that would mitigate the potential harm they inflict on society. For example, fossil fuel can develop renewable energy, as an example. And the hope is that trading will lead to pricing or to stock price reflecting managers' action, taking those corrective action, thereby rewarding managers who are reforming and punishing those who don't. Okay, so providing incentives through the stock markets. What is the downside, potential downside? Is that, well, if you're going to hold some brown companies in your portfolio, potentially you are feeding those brown firms with capital, kind of the opposite from exclusion. So the question we ask, well, which divestment strategy is more effective? And to that end, we develop a simple framework to study exactly the trade-off between these two divestment strategies, tilting and exclusion. We're going to have a brown firm. So in our world, the firm is always going to emit some negative externalities. It will be run by a profit maximizing manager, but the manager can take some action to mitigate that harm. And we're going to have some primary market and secondary market, and a responsible investor who can choose between either to tilt or to exclude. Okay, so that's the framework. So before I'm going to dive into the model, let me just describe very broadly what are the main takeaway, and hopefully I'll get to most of them. But if not, then at least you know the punchline. So the first thing we're going to argue, maybe the main message, is that tilting can be an effective strategy to make companies more socially responsible. The providing incentive to reform channel can actually dominate the starving of capital channel, which means that we think that holding a brown firm can be socially responsible, doesn't have to be irresponsible. And in many ways, we think this is kind of a new novel argument against exclusion. Okay? And we're going to derive the condition under which tilting will be more effective. Now, in addition to that, we are going to show that a greenwashing concern of asset managers can deter those asset managers from learning about their portfolio companies and tilting, so can make tilting somewhat ineffective. And tilting relative to exclusion is more effective or is less sensitive to the presence of some arbitrageurs who can buy the stock that the responsible investors is not buying. And also to deviations from profit maximizations. Okay? So in many ways, tilting is more aligned with investors not just being socially responsible, but also deriving financial returns for their end investors. The second set of results talks about the interaction between ESG or ENS disclosures and tilting, and we argue the two are complement in the following sense. If companies provide more precise and accurate disclosure about their environmental and social activities, that would make tilting more effective. And at the same time, if more investors adopt the tilting strategies, then firms will have stronger incentive to provide more precise information about their ENS activities. So in that sense, they are complement, and tilting and ESG disclosure can be self-fulfilling, which creates some room for potentially for regulation to try to coordinate economies on the high ESG disclosure and prevalent tilting strategy adoption. Okay, so this is the main message. Let me now take you to the details of the model. Now I know everyone is after lunch, you're energized and kind of ready for some hardcore theory. No, I'm kidding. This is going to be very simple, I hope, and I try to keep it kind of at a high level. Okay, so what do we have? We have a brown firm. Long-term value going to be noted by V. It's going to raise some capital by selling Q shares from investors. The investment is going to yield a return of R. There are going to be some negative externalities F, and importantly, a corrective action the manager can take, denoted by A. Okay, investors. So we're going to have households which are risk-averse, have a car utility, and a responsible block holder who is going to be risk neutral and zero endowment. Everyone is going to trade in a competitive market. Stock price is P. Okay, so let's see the details. So initially, our responsible investor is going to announce the trading or the investment strategy. So you can think of X of A is how many shares the investor is going to purchase depending on the corrective action taken by the firm. So if the investor is going to adopt an exclusion strategy, it means that no matter what action is taken by the firm, A being 0 or 1, the investor is not going to buy any shares. And if the investor is going to adopt a tilting strategy, it means that if and only if the firm is going to adopt the corrective action, they will invest in that company. Okay, and we're going to assume that the investor can commit to that strategy at the outset. You can think of deviation from that commitment or that announcement would result with some withdrawal of funds or potentially even regulatory intervention. And we have some extension in the paper where we discuss setting in which investor cannot make that commitment. Okay, so the first thing, investors announce their divestment strategy. Then managers, which are profit maximizing, are going to make a decision about whether to take that corrective actions or not. Taking the corrective action is going to divert some resources of the firm from perhaps some profitable project into maybe cleaning up. So there are some costs. Cost is going to be C, reducing profits. But it's also going to reduce the externalities, the negative externalities. So that's the benefit. In that sense, it's corrective action. And then the action becomes public. And again, we have an extension where the action is not perfectly observed, only observed with some noise. Think about ENS rating, and also an extension where we endogenize the precision of the signal that the market get to observe. Okay, but in the baseline model, this is simply made public. Okay, so after manager makes that decision, the firm is going to issue some shares, Q. We're going to assume it's exogenous for simplicity, to finance the investment. So if you're going to sell Q shares, the price is P. The overall amount of fund raised is Q times P, and the return is going to be R. And given that, there's going to be a competitive market for share. The supply is the initial amount of shares, which is normalized to be 1, plus Q, how many new shares are being sold. Demand is coming from the household and the responsible investors based on the committed divestment strategy. Okay, so that's the market is going to clear, and price will be determined this way. We have an extension where we add an arbitrageur, an investors who can pick up whatever shares are not being acquired or purchased by the responsible investors, and we analyze basically the sensitivity or the effectiveness of each of those strategies once arbitrageurs exist. Okay, and finally, firm value is realized. Firm value has an asset in place component, which is denoted by theta, and the investment from the return from the new investment, as well as the cost, potential cost of taking the corrective action. And we're going to assume the following structure for externalities, which are also going to realize at that point. The functional form is not that important. It gives us some tractability. What is important is that the amount of externality the firm is inflicting is increasing with the size of the company. So in particular, if they invest more, there are going to be more externalities. But they are decreasing with the corrective action, A. And this parameter, this Chi, I believe, is measuring how effective that corrective action is. Because that parameters will play a role in the analysis. Okay, so what managers are doing in this model? Managers are just maximizing some weighted average between the firm's long-term value and the current or the short-term stock price of the company. So you can think of this parameter omega, which is the weight managers put on the stock price, as coming from some a takeover threat or reputation concern, being worried about being fired. We are not micro-founding that in the model. There's a large literature in corporate finance talking about that, and that parameter is going to play a role in the analysis. Okay, so managers are not socially responsible. They are just maximizing this, combination of firm value in the long term and the stock price. What is investors doing? The responsible investors? Well, they're minimizing externalities, which are this F function. They're choosing their divestment strategy to minimize externalities. Again, we have an extension where we allow the investors to trade off the externality reduction with gains from trading. Okay, so we do it in an extension of the model. Okay, so the households are going to solve a pretty standard mean variance problem, and we're going to get a usual expression for their demands. Okay, so this is basically the model. I will not take you through all the details, but one thing we can do in this model is to get the stock price in a closed form. So you're getting this expression. What I really want to highlight is that the stock price is affected by the action taken by the manager in two different ways. The first one you can see here. If the manager is taking the action, then the action is going to reduce profits of the firm. That's going to be reflected potentially in a lower stock price. But at the same time, the blockholder trade, which will depend on the action taken by the manager, also affecting the stock price. In particular, the more the blockholders is going to demand or purchase, the higher is going to be the stock price. Okay, the elasticity of demand is partially influenced by how many shares are going to be issued and the risk aversion of the household. Okay, so more demand by the investors is going to put some positive pressure on the stock price. Okay, so we can talk now about managerial incentives to take the corrective action. And in equilibrium, the manager is going to take the corrective action if and only if the amount of shares purchased by the blockholder when the corrective action is taken is sufficiently larger than the amount of shares purchased when no action is taken. Okay, so it has to be above this cutoff. Essentially, what the manager is going to do, they are going to take the corrective action if it's going to increase, if they expect it to increase the stock price by a large amount. Okay, so in particular, the action is more likely to be taken when the cost it inflicts on the firm, on the profits of the firm, is small, and when managers are more sensitive to the short-term stock price. Now, you can think of this cutoff here, which is a function of all those parameters, as an incentive contract. So if you think about what is the optimal divestment strategy, well, if the manager is not taking any action, you never want to buy shares in this company, because by providing capital, the stock price will go up, which allow the firms to raise funds at a lower cost and expand more, therefore more externalities. So you always want to minimize how many shares you're going to buy if no corrective action is taken. If a corrective action is taken, now you have basically two options. If you're not going to induce the corrective action, if you're giving up on this, then the best thing you can do is to exclude. Basically, never buy shares of this company, even if it's going to take a corrective action. So whenever x equal x of 1, that is the amount of share purchased by the blockholders when the corrective action is taken, is 0, we're going to have an exclusion. The blockholders is never buying shares. But if you are interested in inducing the corrective action, then the blockholders is going to buy the smallest amount of shares that would still induce the corrective action by the managers. How many? Well, you're going to buy exactly delta x, which is the cutoff here. Okay, so the blockholders doesn't want to buy more shares than that, even though buying more shares will still induce the corrective action, because it will also further decrease the cost of capital for this firm and will facilitate expansion. Okay, so you want to avoid that. So these are the two strategies that essentially the blockholders is facing. And the question is, what is the trade-off? Which one should the responsible investor choose? Okay, so here is the intuition. So let's start with exclusion. Under exclusion, the blockholders is always going to sell or never going to buy shares of this company. The implication of that is that the cost of capital of this firm is going to be relatively high, and therefore the firm is not going to expand as much. This is actually good news from, I have only 1 minute? Is that right? Yeah. We'll give you a couple extra. Okay. Okay, I'm getting to the main point anyhow, so well, maybe 3 more minutes. Okay, so blockholders always going to sell, therefore going to have a higher cost of capital, lower share price, therefore less expansion and lower, and externalities are going to be reduced. That's kind of the idea behind exclusion. Of course, the downside of that is that, well, we are providing no incentive to the manager to take the action, which is going to increase externalities. Tilting is almost like the flip side of that, because the blockholders is going to buy if and only if the corrective action is taken. So what does it mean? It means that, well, the blockholders will hold a brown company in their portfolio, so it's going to have a higher share price and a lower cost of capital, larger expansion, and therefore more externalities. But at the same time, it is going to provide incentive to the manager to take the corrective action, which is going to reduce externalities. Okay, so we have this trade-off. If we put it just in one slide, exclusion is going to increase the cost of capital and therefore limit the firm's expansion, which is good from the perspective of the externalities. Tilting is doing the opposite. However, tilting is providing incentives where exclusion is not. So in a contracting setting, you can think of exclusion as a strategy where you're paying a CEO a flat salary, which is perhaps cheap to the firm, to the shareholders, but provide no incentives, whereas tilting is maybe more expensive because you have to provide some pay for performance structure to the manager. Okay, so again, we can put everything write it in math and have deriving this cutoff, which is determining essentially the circumstances under which tilting is going to be optimal, and we can do some comparative static. But really the main message we have is that tilting can be more effective than exclusion, meaning that responsible investor should not divest an entire sector. It's okay to hold perhaps the best asset in place. And we show that the tilting should be used when the corrective action is cost effective. So we imagine that in a fossil fuel industry, developing some renewable strategy can work, but perhaps in controversial weapons, there is no corrective action that is going to be cost effective. Or it's going to be tilting more effective when managers are more concerned about the stock price. This way, buying small amount of shares is going to have a large impact relatively on the managers. So providing incentive to managers is going to be relatively cheap. And we also have a little bit more complicated comparative static with respect to the growth opportunities. We basically show that when the firm has very little growth opportunities, then of course tilting is going to be optimal because, well, the firm doesn't need to raise any capital to begin with. But also when firms have very large growth opportunities, the multiplicative basically nature of the externalities is going to imply that corrective action will be particularly important as it affects the firm across the board. Okay, so we have a few implications for regulators. And in particular, we just want to highlight that the fact that institutional investors hold brown firms in their portfolios should not be an indication that they are greenwashing. In fact, regulators should potentially encourage firms to tilt. And those firms that argue that they're screening out socially responsible firms from the portfolios should be really scrutinized in the sense that they don't entirely divest a sector, and we should treat them as closed indexer in many ways. Okay, we have a bunch of extension. Let me just skip that. And perhaps the one thing I want to say is that tilting is very similar to choosing the best asset in class in an industry, let's say in a fossil fuel industry. What it means in practical terms that you should really look at industry-adjusted ESG measures as opposed to just the average. And I also want to highlight that a lot of this discussion was, well, we should divest from the entire fossil fuel industry, but only hold perhaps Chevron, or I don't know, the best asset in class. But the opposite is also true, okay? Meaning that we should not include all green firms in our portfolio. We should actually lean away from the worst green companies in class. The very similar logic would apply. Sorry for going over time. Thank you so much.
Thank you very much for having me here. I enjoyed the papers and the conversations very much and learned a lot. And this was a fun paper to read and think about. So what is the research question here? So, OK, so suppose that we have a block holder who wants to minimize the externalities that the firm induces, negative externalities that the firm induces. What is the best strategy? And of course, this is very topical given the rise of the ESG movement. So the paper proposes a theoretical model to tackle this question. So you have a firm that finances an investment opportunity with equity issue. You have some trading between risk-averse investors and this risk-neutral block holder. And you have the manager that can take a costly action to correct a negative externality partly. So the block holder commits to an investment stake as a function of the manager's action in the base model. And the question is like what this investment rule, optimal investment rule, is going to look like. So there are lots of results, but the key takeaway, I would say, is that if this corrective action is sufficiently valuable, then tilting is the right strategy and exclusion is the wrong strategy. Okay. So in the discussion, I will give you a simple model, which is like way simpler than what Doron presented. It's, of course, like a lot richer. And then I will give a few comments. So I will give one comment on theory and a couple of comments on kind of practical implementation aspects. Okay. So suppose that we have a firm that imposes some negative externality, which is the function of the stock price and the function of the manager's action. So let's assume that it's increasing in the stock price. So the higher the stock price, the higher the externality. And in the paper, this arises endogenously because with the higher stock price, the firm issues more shares and expends more, and so the externality is higher. So the externality is lower if the manager is taking action 1 than the action 0, but this action costs C. So suppose there is a downward sloping demand for shares from investors. So Q is the number of shares that the investors buy. So if the block holder buys X shares, then the investors have to hold 1 minus X. And so the price is basically increasing in the block holder stake with some slope beta. And that's exogenous here. So if I'm a block holder here, I basically want to induce two things. I want to make the price as low as possible. And second, I want to give the manager incentives to take action 1 rather than action 0. So this is what makes me happy in terms of reducing these externalities. So when does the manager takes action 1? So the manager cares about the stock price. This is what the IC constraint. So the price impact due to this additional purchases by the block holder is higher than the cost of taking this corrective action. So the block holder here faces the trade-off. So on the one hand, I want the manager to take this corrective action, so I need to make x1 minus x0 high enough, because otherwise the IC constraint is violated. So on the other hand, I want to make the price as low as possible. So how do I make the price as low as possible? But buying as little as possible. So if I could short, I would short, but I'm limited to long positions, so I would want to set x1 and x0 to 0. So if corrective action is sufficiently important, then this piece is the more relevant one. And so I set x0 to 0. So if there's no corrective action, I don't hold anything. And I set x1 just enough so that the IC binds. So the manager takes a corrective action, but the firm size is too big, but that's kind of the lesser of the evils. So if the corrective action is insufficiently important, then I don't buy anything. So the firm size is small, which is good, but unfortunately there is no corrective action, which is the necessary evil here. Okay. So this is the key takeaway. So one comment on the theory, kind of that will be the main comment that I will discuss in the discussion here, is to think about kind of the role of contractability of corrective actions. So basically, the argument works like really beautifully if the block holder can commit to make an investment strategy as a function of the manager's action, or as a function of some informative signal that's nicely correlated with the manager's action, like let's say kind of a precise ESG score. So after the action is taken, the manager would want, the block holder would want to deviate from this investment. So let's say if the manager takes a corrective action and the block holder only cares about the externality, the block holder would want to sell everything to push the stock price down to limit the firm's size. If the block holder cares about profits and the manager does not take the corrective action, the block holder ex post wants to increase the investment stake because there are gains from trade, and both things kind of destroy the ex ante incentive compatibility of the manager. And if A is hidden and there are no good investment, no good signals, so like such promises will be difficult to enforce. But first, let's think about if A is contractible. So then tilting works very beautifully, kind of very clean argument. But this points to some questions about other mechanisms that we could think about that could achieve similar objectives if the action is indeed kind of contractible. So first, the block holder can directly promise to pay the manager because for taking the corrective action. Also, the block holder could buy some shares and push the board to make compensation contingent on A, like emissions, ESG scores. Or the regulator could induce corrective actions because A is contractible and observable. And of course, there are kind of limitations of all of this. And I think an interesting question for the future research, in particular, thinking about interactions between contracting with the management and investment restrictions on block holders' policies, how they interact with each other. I think that will be pretty interesting. So next, let's think about A is not contractible. Suppose that corrective action is not contractible at all. There are no public verifiable signals that are informative about it. It's pure private information by the manager and by the block holder after the manager takes this action, and then nobody sees it. So then block holder cannot commit to investment rule X of A. So in section 1, the authors analyze the case of no commitment whatsoever. So the block holder can choose any trading policy that they find optimal. And I think it can be interesting to expand this analysis. So in particular, the analysis I would like to suggest is to think about the following problem. Suppose that the block holder cannot commit to saying, I'm going to invest this much if you take action 1. I'm going to invest that much if you take action 0, because action, nobody sees it. But the block holder can impose restrictions on the investment set that it can choose from. Specifically, I think tilting contract can still arise in the following sense. So the block holder would choose a restricted investment set X. So then, after the manager takes the action and the block holder will see it, like what the true corrective action is, the block holder would choose an investment from set X that it picked in advance. And we can choose set X so that if the manager takes no corrective action, then the block holder would find optimal to pick X0. If the manager chooses corrective action, the block holder finds optimal to pick X1. The gap between X0, X1 and X0 is sufficiently high so that the manager's incentive compatibility is satisfied, and X1 and X0 kind of optimize the utility of the block holder. In particular, one case would be X0 equals X1, X was 0. Then that's basically an exclusion contract. So no matter what happens, you don't invest anything. And the question we can ask is like what this optimal restricted investment set looks like. I think it's a very interesting question. It's actually related to this paper by Amador Werning and Angeletos in macro theory in a very different context. So this contract will have a very realistic implementation. So it will basically be block holder will say, I'm going to invest between 0% and 1% in brown firms, depending on what my opinion is going to look like about whether the manager does a good job to limit emissions. So nobody really will see like whether the manager does a good job or not. But this restriction to not invest more than Y under some conditions will kind of be very efficient providing incentives to block holders. And this will only be feasible if the block holder cares about profits to some extent, which is similar to the author's result in section 5.1. Okay. So, and this analysis will have implications relating these optimal restrictions on investment to block holders' motives. So if block holder is purely pro-social, then the exclusion contract will be optimal no matter how high this, how important this corrective action is. It's just the only thing that you could do here. If block holder is profit-driven but a bit pro-social, then there will be tilting contract. If block holder is purely profit-driven, then no restrictions on the investment set is optimal. Okay, and last two comments very briefly. So I was wondering how quantitatively relevant this force is. So Berg and Van Binsbergen had a fairly influential paper that argued that exclusion quantitatively had a very small effect. And in principle, it can be interesting to do a similar calibration for tilting. And finally, I think it can be interesting to think about interactions between raising capital for corrective actions. So in the model, these are two separate. But in reality, let's say corrective action of a coal power plant would be switching to a cleaner technology that's very capital intensive and that requires some equity sales. So I think much of the analysis will be different, but there will also be some new elements. Okay. So overall, very interesting paper, very topical, interesting question, clean mechanism, and points to a discussion of also other alternative mechanism to induce transition to cleaner technologies. Thank you.
So Doron, you want to respond to the question?
Thank you very much, Andrey, for a great discussion. I mean, I agree. So we kind of have a setting where the action is at least partially observable, but not contractable. Okay, and I agree if it was, which is not always easy to justify. But think of a fossil fuel company that is transitioning into perhaps a renewable energy. It's very complicated. There are many dimensions to that. How easy it is to specify a contract that is going to govern that. But that might be hard, but it might be more easier kind of to tell this is happening to some extent, and that's essentially what we are assuming. But I agree there is a tension between the two, and I hear Andrey comments about how to try to, potentially push even further the analysis of no commitment and see how far we can get with that. We did some, steps in that direction, but we can definitely do more. But thank you very much. Really appreciate that. Yeah, if there are any questions, happy to. Should I? Okay.
So I thought it was really interesting that you said that comparing firms should be within industry rather than without industry, right? And so I don't know if you knew this, but Susta Analytics in, I think, 2018 or 2017 changed. They used to do it within industry, right? So that you would compare firms like best in class, so to speak. And they changed it to be overall. So the ranking completely moved. And so maybe your paper can speak to the efficacy of doing that and why, maybe this isn't the best way to compare firms.
Yeah. No, that's something I should definitely look into. I'm not that familiar with those institutional details. My sense is, I think our argument is really about some companies are going to have negative externalities no matter what, okay, some sectors. I think a lot of investors seems to be have the view that, therefore we should just completely kill those industries. And we kind of say, well, it's a little bit extreme. There is something you can do in the middle. And the idea of adjusting for industry, the ESG rating, I think it's very simple. As economists, we all do it in so many different contexts. We just say, it's a simple idea. We just say we need to do it also when we apply it to this particular.
But I think it points to sort of societal views about exactly what you're saying, is that we should not have any brown industries, that it's terrible. Instead of saying, here we have industries that have these externalities, they can't get rid of them, who's doing the best at trying to correct them? So. I just thought it was very interesting that this large rating agency went and changed it completely, went from what you thought was good to what is not so great.
Okay, thank you.
Super interesting paper and discussion also. So a quick question sort of about organization design. Are you willing to say anything about Omega or W or whatever you're calling it? And would the shareholders, how would they be choosing W here or Omega? And how, if they chose differently, how would the regulators do it?
Yeah, I mean, it actually goes back, not exactly to Andrey's point about how to think about investment and also contracting. A lot of time, this Omega, what is Omega is how much weight the manager is putting in his utility and his objective function on the current stock price as opposed to what happens to the firm 5 years from now. So I think the right way to, if you want to analyze the optimal, so let me take it back. So perhaps one way to think about our paper is that if you were to analyze the optimal Omega, the optimal weight managers should have on the stock price, well, there is also a benefit from an environmental or social perspective. But there could be also other costs. There is a whole literature about managerial myopia and how those things can be very detrimental. So we are not really touching that. So there are trade-offs. Therefore, I'm not willing to say we should have more short-term compensation for managers. There is an obvious cost to that. But I do think that no matter how you design the optimal contract, it is going to leave some residual weight on the short-term performance of the firm. And that's something that can be exploited by responsible investor.
You did a very nice job of not taking the bait.
Okay.
Doron, very interesting paper. I was just curious why you restrict, consider just tilting policies. I mean, I guess in a dynamic setting, I have in mind, if you allow for punishment strategies, like if you spill, I'll divest from you permanently, or with some very low probability you get let back? I mean, some form of folk-like theorem should apply, and you could probably quantitatively, achieve even better outcome.
So we could consider a more complicated, I think, strategy space in both dynamics, but also perhaps even, the action can be partially taken, and perhaps there is also other, I mentioned like engagement and other mechanism. I think we really want to make a relatively simple point about this trade-off between what I think is two prominent strategy, the exclusion and divestment, and compare the two like in a horse race. I think it can be extended along the lines of what you mentioned, but at the end, punishment is a form of exclusion or a form of exit. So I don't know exactly, we can chat more about what exactly you have in mind, how to push it further.
So something like, if I'm going to invest in you, but if I see you do some oil spillage, I'll divest from you. And for like a really long time, basically. So like this folk-like theorem, punishments.
Yeah. So if you had like a repeated setting or a dynamic setting, then the space of action you can take is going to be richer. Am I going to divest for 1 period, 5 period? And so I agree that could be an interesting extension of this model. Yeah.
Thank you. Yeah, so I was just thinking, like, how important is it to have this corrective action in the paper? Because if you think about the exclusion contract, right? So it's like an extreme pay performance sensitivity. If your ESG performance is below something, I think you're brown, I just do 0. And then if you're above threshold, I think you're green, I just do 1. So it seems like what's working here is you're making a more fine contract, which is with better pay performance sensitivity in the sense that instead of having this step function, you're having this continuous function, which is basically saying I'm going to invest more in you if your performance is better. So it's not 0 or 1. So I was just thinking that this within the class rank kind of speaks to that, right? So alternatively, if I have a contract basically just saying that how many shares I'm gonna buy from your company really depends on this finer relative performance, but not depending on this corrective action, would it have the same effect in terms of then these brown companies, they would still want to compete to have better performance on ESG? But before it's like a more coarse incentive of 0 or 1.
Yeah. I mean, I guess my response to that would be a corrective action might sound as a very generic name, but I would think that the ESG rating of a company, if you have a relatively precise environmental score for fossil fuel company, that will be affected by certain action that they are taking, how much they're going to clean up. And that's what we want to emphasize, that the rating is potentially endogenous, okay? It depends on action that firms are taken, and we think investors should account for that and basically not completely exclude from some industry that no matter what they do, they will always have a very low rating because, well, they're in the fossil fuel. So yes, we are refining that at some level, but we want to emphasize that firms have influence over their externalities, and we want to incentivize that, basically.
Hi, super interesting. Thanks for sharing. I just want to ask kind of a basic question in practice, right? So when both of you guys were speaking, my mind went straight to an investor, right? Norges, I think, is a good poster child for divestment and even for engagement and things like that. In practice, I don't know if you've looked at this or even if you can maybe pontificate on this. They have a very strict divestment policy, specifically for coal and oil and gas companies. And they also are a very, very high engager in companies, too, so they kind of take both sides. Have you ever looked at what their fund performance has looked like over, say, 10 years or something like that, just to see if maybe this type of analysis might kind of fit the mold of a super large investor like them?
Well, strictly speaking, we haven't looked empirically at that. And, I think in many ways, it's true that some firms are doing engagement and exclusion. It seems to us that not many firms or investors are doing tilting. I think one view, I think the paper has some positive but also normative implication, and we hope to a little bit at least educate the market about, you can do tilting, or at least consider that, and then see, then maybe like a few years from now we can see what the effect might be. But I don't know if a study of empirically looking at between these two strategies. But I think we should be, doing more research on that end.
So we're going to have a 5 minutes break, and then we can continue later.
We'll come back 5 minutes late.
Sure. Yeah, 2:55.
Okay. Thank you.
Thank you.